Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 179 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today we are going to be talking about interest rates and how interest rates work, how they are set, and what they mean for you in your financial life, and how you should go about thinking about interest rates when it comes to doing things like cleaning up your debt or buying new products. Hopefully, you can avoid the interest rates when buying new products, but things like homes and things that we would be okay with financing, which really just comes down to your home, right? But I know that is not necessarily just the reality for all of you. I know many of you have debts outstanding that you do need to get cleaned up. And this will help us to dive deeper into our discussion of financial literacy, of things that you need to understand better if you are going to be a good manager of your money over the long term. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So when it comes to your debts and paying off your debts and anything surrounding any debt that you may have, everybody has an opinion on interest rates, and everybody has an opinion on the rate that they think they can get to borrow to purchase some asset, or you need to refinance that rate down, that rate's too high, all these different things, right? Well, we're going to get a better idea of what exactly interest rates are and how they're set in today's episode. But let's just begin at a baseline, right? Let's begin at a baseline of what is an interest rate. An interest rate is the amount that a lender charges for the use of assets expressed as a percentage of the principal value. Okay, so the principal value is the initial value for which you're going to purchase some asset, right? That is the principal value. And the interest rate is going to be some percentage of that value, of that initial principal value that the lender is going to want on top of the principal value in order to allow you to borrow for whatever the asset is. Interest rates are typically noted on an annual basis in a form known as the annual percentage rate, and you probably see this as APR very often, right? You'll see this on car commercials. You'll see this on credit card commercials and credit card mail outs that you may receive. You'll see this all over the place, whatever percent APR. And that is the annual percentage rate. And we'll dig into the APR just a little bit more here as we move forward. But the assets that you could borrow and be charged an interest rate on that particular asset could include cash, consumer goods, large assets like a vehicle or a building, or a myriad of other things, right? But borrowing is not free, even if, because we talked before about 0% borrowing, getting a 0% rate like on a new car or something like that. Borrowing is still not free. You think you're not, losing to whoever lent you that money. They're not going to lend you money for free. They're just baking it in to the price of whatever the asset is, the cost that they would, have you pay in order to lend you that money. It may be a lower cost than others, but they're still going to bake it in to the price. And so borrowing is not free. Okay, so that's an important thing to understand right up front. And that's why when I set up the financial action plan and I try to teach you guys how to manage your money well, we talk a lot about staying out of debt, getting out of debt, and staying out of debt. And so we don't want to be on the wrong side of interest rates. We don't want to be on the side where we are constantly having to pay interest on these different assets and continue to drain our cash flow towards this interest that is not benefiting us in any way. Interest is just making things more expensive, and that is not beneficial to you or me. And so that's why we need to try to stay out of debt if at all possible. And the good news is that it is possible. It is possible to get out and stay out of debt. And you may not think it's possible right now, but maybe you haven't put the things in place in order to try to get yourself out of debt. Maybe you don't have a budget. Maybe you don't have a good plan in order to work to try to get yourself out of debt. A plan is required to stay away from having to ever pay interest on something. A plan is required in order to, have the cheapest purchasing options for something, and that is paying in cash for whatever it is. Yes, it may seem like in the short term that financing something is a better idea, but over the long term, it's just going to be a drain on your cash flow, and it's not going to allow you to build the financial life that you want to build. And so an interest rate is something that we're going to look at in a fairly negative light, but in the same way, I want you to understand what they are. I want you to understand how they're set. That way you can be a more informed individual, a more informed money manager, and a more informed individual when it comes to consuming products. So when you go, let's say, and you were going to finance a vehicle or finance your home or whatever it may be, and we don't want to finance vehicles, and I'm okay with taking out a mortgage, but let's say you went and financed your vehicle, okay? And you go and finance this vehicle, and what happens? They ask for, your pay stub. They ask for, how much money you're going to put down. They want to, do a credit check on you, all these different types of things if they are going to lend you money. Well, when they do those credit checks, when they make all of their determinations, what they are trying to see is how credit worthy is a potential borrower. And depending on how credit worthy you are, they are going to set some interest rate that they will offer to you in order to factor that into your payment. Because each payment that somebody makes is made up of two parts. Your payment is made up of part principal and part interest. And the principal portion of a particular payment is actually going towards paying down the debt, right? It's actually going towards paying down whatever you owe. But the interest portion is just going towards whoever let you borrow the money, and that is their charge for actually letting you have that money over some period of time, or letting you have a particular asset over a period of time. And so if you are more credit worthy, then you will have a lower interest rate. If you are less credit worthy, you will have a higher interest rate, or you will not be offered any credit for something at all. So when the borrower is considered to be low risk by the lender, the borrower will usually be charged a low interest rate. If the borrower is seen as high risk, the interest rate that they are charged will be higher. Risk is typically assessed when a lender looks at a potential borrower's credit score, which is why it is important to have an excellent one if you want to qualify for the best loans. But again, we're not out here looking for loans. And we've talked before about the only reason that we're concerned with our credit score at all, or that it may be important to maintain a good credit score at all, is to get a loan to purchase a home, right? Otherwise, we are not going into debt. We're not going into debt to purchase vehicles. We're not going into debt to take out loans, for personal loans or credit cards. We're not using credit cards and building up balances on credit cards. We do not want to have to pay interest because it is just going to be a drain on us over the long term. Now, maybe you're interested where these firms may start, right? The lenders, where might they start when actually offering you some amount of money or offering you some amount of credit for some asset, right? Where do they start with setting their interest rates? Well, the place that they typically start is the federal funds rate, right? The federal funds rate is a rate that is set by the federal government, by the Federal Reserve, right? And the Federal Reserve, they get together every 6 weeks or so, the Federal Open Market Committee, which is all of the presidents of the Federal Reserve banks around the country, and they get together with the Fed chairman, Jerome Powell, and they talk about what they think should happen when it comes to monetary policy. And monetary policy is this idea of going and setting interest rates and making sure that there is an adequate amount of money in the economy at any given time, depending on where we are at economically. And what they will do is they will determine what the federal funds rate should be set at. And that federal funds rate is the rate at which commercial banks can borrow from one another, and it's also known as the overnight rate, right? They lend their excess reserves to one another in a short-term fashion, right? They lend to one another. Well, in lending to one another, whatever they extend to us in the form of credit, whatever they extend to us in the form of a loan or something, right? It is going to have to exceed their cost of borrowing that money in the first place, right? It's going to have to exceed that cost so that they can make some premium. They can make some money on whatever money they lent to us. So they will start with some federal funds rate, right? That federal funds rate, and they will determine some premium above that federal funds rate at which they think that certain levels of credit-worthy individuals should be receiving loans or should be, paying that amount of interest. Now, the minimum amount that they're going to begin above the Fed's fund rate is what's called the prime rate. And the prime rate is the interest rate at which banks lend to customers with the best credit, with good credit. You can receive a prime interest rate. It's the best, it's prime, right? But that's still some premium above the federal funds rate. And so you start with the federal funds rate, banks borrowing, from one another, and then they lend out to the best customers at the prime rate. And then everybody else will get a higher rate, relative to their potential credit worthiness above the prime rate. So how in the world would something like the federal funds rate apply to you? Well, during the coronavirus pandemic, what have we seen? We have seen that the Federal Reserve has had to step in and make a lot of changes within our economic system. They have had to pump a lot of money into the system. And not only have they pumped a lot of money into the system, they have also gone about decreasing the federal funds rate in a large way. Well, what happens when the federal funds rate gets brought down as low as it has? And it's basically been brought to 0%, right? Well, in being brought down that low, that means that banks now will also lend at lower rates. So it makes money cheaper in the economy. It makes money cheaper for corporate borrowers and for consumers like you and I. And so if you have tried to get some type of home loan, let's say, for the past 12 months, then you are getting record low rates. You are getting some of the lowest rates that we have ever seen. And the reason is because our monetary authorities, the Federal Reserve, has stepped in and has made those changes to those baseline rates, to the federal funds rate. And then obviously it decreases the prime rate that is offered to consumers like you and I. And so it does matter. It does matter what the Federal Reserve does. It does matter when it comes to the amount that you're going to be paying on whatever money you borrowed. It does matter. And it has been, a big reason why housing costs have increased as they have in the past year. Because, hey, if it's so cheap to borrow, we're going to have a lot of refinances, which we absolutely have. We've had a lot of individuals that have taken out loans to purchase homes. And the more that people purchase, the more that, the demand goes up for some money, then not only will the price of whatever the asset is that we're trying to borrow for, not only will that go up, but it's also going to push up rates as a whole. And it has slowly but surely pushed up rates like the 10-year Treasury bond yield over time over this past year or so. And so you see things like that occur, and you want to know why. You want to know why money's cheap. It's because our monetary authorities have allowed it to be. And so that's where we begin. That's where we start when it comes to interest rates. Now, interest rates apply to most lending or borrowing transactions. Individuals borrow money to purchase homes, fund projects, launch businesses, pay for college tuitions, all these different types of things, right? You have had an interest rate on credit cards, on student loans, on your home, on your car, all these different types of things. Well, all of these are always going to be costs to you. Those interest rates are always going to be costs and drains on your cash flow, which makes them so negative in my eyes and in the eyes of many, and should be negative in your own eyes, right? We do not want to be accruing interest. We do not want to be paying interest on depreciating assets like cars over time. We don't want to be paying interest on student loans, right? Something that is not even tangible over time. We just want to pay the least interest possible when it comes to the mortgage that we take out, because that's going to be some of the most interest that we ever pay, right? We want to minimize our interest, and the interest rates, they are that price that we would pay. They are that price that we would pay for borrowing in whatever way, shape, or form that we may be borrowing. But again, we do not want to be borrowing. We want to be paying for things in cash. Now, interest rates in general, right, are stated, I said earlier, as like the APR, right? So your credit card may say it is a 25% APR, 24.99. That's a real common one, 24.99% APR. Okay. Now that means that on your principal value, every year they're going to charge you 24.99% in total interest. Now, that does not mean that 24.99% is what you would pay if you just paid the interest, though. What that means is that is the amount of interest on an annualized term, right? That's when we're talking about things happening annually. But with something like a credit card, it is not going to happen annually, right? You're going to accrue interest on a monthly basis. So what's going to happen is they're going to take that APR and divide that APR by the number of months in the year, which is 12 months, right? And so let's just say for ease of dividing here that it's a 24% APR. Okay, not 24.99, but 24%. So you take 24%, you divide by 12. That means they're going to charge you 2% per month, okay? Well, let's just say that you are just paying the interest on a, let's say, credit card, right? You're just paying the interest on this particular credit card. Well, you are going to pay 2% per month on a particular amount of money, okay? Now, if you are just paying the interest off every month, well, the interest is going to remain the exact same, right? So let's say you have $1,000 balance and you are charged 2% in interest every single month, right? Well, that $1,000, you're only going to have to pay $20 towards that $1,000. Now, this isn't super realistic, but it will paint a good picture for you, okay? If you're just paying the $20 per month, then you actually are going to pay 24% interest over the course of that year because you'll end up paying $240 in interest. But if you have a larger balance on the credit card, let's say $10,000, right? Let's say you have a $10,000 limit on that credit card and you have maxed it out, okay? And you are being charged 2% a month on that $10,000. Well, that's $200 per month, okay, in just interest. Well, let's say your minimum payment is only $150, and so you are just making the minimum payment. Well, if you're making that minimum payment of $150 when interest is $200, then your interest is outpacing your payment. And given that your interest is outpacing your payment, next month, your interest is not going to be based on that original $10,000 balance. It's going to be based on $10,050 because you made a $150 minimum payment when the interest that was accrued on that particular credit card was $200, right? So you had an extra $50 that you didn't pay. So the amount of money that you're going to owe in interest is going to increase, right? The dollar value, even though the percentage remains the same, the dollar value increases. And so over the course of the year, you're actually going to pay more than the percentage rate. You're going to pay more than that stated APR. You're going to end up paying what we call an equivalent annual rate, right? This EAR. And what the EAR does is it takes the APR and it accounts for compounding. It accounts for the fact that that particular percentage is not just based on the original principal, that it's based on a new amount every single month. So it is that compound interest idea that we have talked about for so long, right? That compound interest thought process where the more compounding periods, the more costly something is, or the more compounding periods when you're investing, the more that you will actually earn above the particular APY, in that case, annual percentage yield, right? That is when you're earning an annual percentage yield like on a CD or a bond or something like that. But when we are borrowing, right, we have this APR that we have to pay, but we have to know that if it's on a monthly basis or a daily basis, like student loans, they accrue on a daily basis. A lot of people don't know that. So they wonder why the interest on their student loan runs up so fast. Is because every single day it is accruing interest once it accrues interest, right? Some loans, they don't accrue interest until you're out of school or whatever. But every single day they are accruing interest, which is going to make it more costly than the interest rate that is stated on the particular loan that you're trying to pay on or pay off or whatever it may be. And so you can see how these terms on these interest rates, right, how they are compounded can have a big impact on the amount of money that you end up paying. Now, what drives our interest rates, right? What actually drives the setting of higher interest rates or of lower interest rates? Well, the interest rates charged by banks is determined by a number of things, such as the state of the economy, right? Our central bank, like the federal government, can set the interest rate, which each bank uses to determine the APR range that they offer based on a particular consumer's credit worthiness. When the central bank sets the interest rates at a high level, the cost of debt rises. When the cost of debt is high, it discourages people from borrowing and slows consumer demand. Also, interest rates tend to rise with inflation. Okay, so it makes sense, right? As it is more costly to borrow money, right, that makes it more costly for people to finance assets. Therefore, they're not going to be going out and buying assets at such a high demand as they may have done previously, right? So it's going to slow consumer demand. And it also says that interest rates tend to rise with inflation. Well, why does that make sense? Because as inflation heats up, meaning the cost of goods and services in the economy is getting higher and higher, we don't want inflation to get out of control because it's going to be very difficult for wages and salaries to keep up with inflation over time if inflation gets too high and runs rampant, right? So we're not going to be able to afford the cost of goods. Okay, so what does the Federal Reserve do? What do central banks do? They step in and they say, well, we will increase interest rates, right, which will put a damper on demand, which will slow down the rate at which the cost of goods and services are rising, right? And so that's why they may increase interest rates. So to combat inflation, they may set high reserve requirements, tight money supply ensues, or there is greater demand for credit. In a high interest rate economy, people resort to saving their money since they receive more money from the savings rate, right? Because with our banks, right, our banks, the rate that they may offer us on a savings account, on a high yield savings account, is going to be directly tied to our Fed's funds rate as well, right? So people will save money instead of spend it. The stock market suffers since investors would rather take advantage of the higher rate from saving than investing in the stock market with lower returns. And the stock market would have lower returns because the cost of debt for companies has risen, right? So if it's more costly for companies to borrow, it's more costly for them to grow. And so they're going to have less opportunities to make certain returns in the stock market, okay? And then businesses also have limited access to capital funding through debt, which leads to an economic contraction, right? But economies are often stimulated during periods of low interest rates, as we are seeing right now, right? They are hoping that these low interest rates, that they stimulate the economy because borrowers have access to loans at inexpensive rates. Since interest rates on savings are low, businesses and individuals are more likely to spend and purchase riskier investment vehicles such as stocks. The spending fuels the economy and provides an injection to capital markets, leading to economic expansion. So this is also a big reason why we see the stock market has gone up during the coronavirus pandemic as well, because once rates were dropped, right, the stock market, it prices in future cash flows. Well, future cash flows are going to be impacted by cheaper money today. And so the fact that money is cheaper today, it means that higher cash flows will come later on. And when higher cash flows come, that makes the value of the companies in the stock market higher, right? And so people will flock to the stock market to try to take advantage of those returns. The important thing for us to understand is that we don't have control over interest rates, right? We don't have control over whether or not we're going to be able to take advantage of higher or lower interest rates at any given time, right? We thought interest rates were on the rise before the coronavirus pandemic. But obviously they were brought back down to earth by something that was unforeseen by everyone, okay? So we cannot control interest rates, so we shouldn't try to, right? We shouldn't try to play the interest rate game. So when you are paying off your debts, right, we're not just trying to refinance everything, although it can be helpful sometimes to refinance if it is, beneficial to you to do so, but you have to take into account the cost of refinancing, because refinancing is costly, especially for something like a home, right? But if it's relatively cheap to refinance something like student loans or something like that, then by all means you can do that to a lower rate. But the fact that we do not control interest rates makes it all the more important to not pay too much attention to them when it comes to paying off our debts. As we've talked about many times before, when you're paying off your debts, you pay off your debts from lowest amount to highest amount. You do not take interest rate into account unless the debts are relatively equivalent in value, right? That's when you would end up taking the percentage, right, the APR of the particular debt into account, because we are not concerned with any small amount of interest that you may accrue over a short period of time. We are trying to pay our debts off quickly, right? And so we don't expect you to have, these huge amounts of interest that you are accruing on anything over the time that you are trying to pay off your debts. We want you to get some small wins and then compound up on those small wins into the bigger and bigger debts as you move forward, okay? So yes, interest rates absolutely matter. Interest rates are important because interest rates, they can have a very big impact on our economy. They can impact whether or not we are expanding or contracting. They can impact whether or not people are going out and buying houses. They can impact a lot of things about people's financial lives. But the way that you can ensure that interest rates have as small an impact on your financial life as possible is to be out of debt, to purchase things with cash, and to focus on things in that way. Yes, interest rates can be very important if you're constantly relying on credit and you're constantly relying on borrowed money. But if you are relying only on your income, you're relying on the money that you bring in, then interest rates are going to play a very small part in your life, as they should. And you're not going to be at the mercy of our governing monetary authorities and the decisions that they decide to make. So take your financial life into your own hands and do not allow interest rates to dictate what you do with your money. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need someone to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I wrap up our week on financial literacy, and I just talk about how can you save money? How can you put yourself in a position to be able to put money back, whether it be just an emergency fund or into investments, and how you can find margin in your budget. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.